You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Rob Carver and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. If you're new to the show, I hope that today's episode will trigger your curiosity enough to check out the back catalog and listen to the past episodes that you may have missed, like my conversation with Rich last week, where we not only managed to answer a lot of questions from our great community, but also discuss some very important concepts when it comes to the most followed CTA and trend following benchmarks. And we explain why our TTU trend following index, which we update each month on the blog section of the website, may be superior, of course, in our own unbiased opinion. Also, if you missed the Wednesday episode in the Global Macro Series, I would encourage you to go and listen to that later this afternoon, because it was a hardcore macro discussion with no other than the dynamic duo of Macro Alf and Andreas Steno Larsen. As you may know, the aim of the podcast is to inspire you as an investor. We want to be provocative, but without being polarizing. We want to challenge consensus narratives, and we want to advocate how to think critically about investing in an uncertain world, and to provide you with a framework and a mindset that we believe is truly robust. And if you want to help us achieve our goal, what we ask of you is that if you can comment, if you can continue to send us your questions, if you can share these episodes with your friends, and not least, if you can rate and review them in iTunes and Spotify, we would greatly appreciate this, as this is the best way for us to see that you're getting some value from our time and dedication each week to create these episodes. And as long as that continues, we will, of course, continue to produce them. With all of that said, Rob, it is great to be back with you this week. So much continues to happen in between our conversations. How are you doing? How are things in the UK?
Yeah, things are okay here. Last weekend we had a 4-day weekend because of our glorious monarch's anniversary of our accession to the throne. So I think the whole country had a jolly good time. And then everyone woke up on Monday and realised that we're still in the middle of a cost of living crisis with massive inflation and with a very unpopular prime minister who no one can seem to get rid of. I think everyone's probably a bit more depressed, even though the sun is still shining. So I guess the Queen's got the weather sorted. She just needs to get the rest of the economy and the political situation sorted as well.
Yeah, well, there we are. They did try, though, to get rid of him, I think, in the last week or so.
On Monday they tried, but they failed, sadly. So, okay. But this is not a political podcast, so let's move on.
It is not a political podcast, but we are allowed to have our opinions. You know, that is the great thing about what we do here. Now, President Biden and the members of the Federal Reserve were hoping that Friday's CPI report would come out below expectations, but to no avail. In fact, each and every one of the economic releases communicated bad news for the leaders. The headline year-on-year CPI came in at 8.6% versus the consensus estimate of 8.3%, and the ex-food and energy tally came in at 6%, a touch above the survey estimate of 5.9%. Later in the morning yesterday, the University of Michigan Consumer Survey offered no better news. The overall sentiment tally plunged to 50 versus last month of 58. And the inflation component over the coming year ticked up to 5.4%. That's clear. That's a clear message to both Biden and Powell of no confidence. The reaction in the markets was as expected, with stocks indices getting crushed. Several market analysts said earlier this week that the stock market could be close to a bottom, but Friday they were eating their words, as the S&P 500 is only now 100 points away from its most recent low. In reaction to the inflation data, economists are actively resetting their expectation for the path of the Fed funds. Several street economists have upped their rate hike expectations to 75 basis points at next week's open market committee meeting. Similarly, the Fed funds futures market now expects the overnight rate to peak at 3.6% by May of 2023. And given the Fed aversion to deviate from their publicly shared comments, the likely outcome is 50 basis points hikes at the next 2 meetings. By the way, we also had the legendary investor Stanley Druckenmiller come out this week warning that the bear market has ways to run as Fed hikes rates. And apparently he lightened up on tech in Q1 and he bought into energy stocks. Speaking about energy, and before we move on to some good news, I did want to highlight that the US oil markets are seeing the lowest stocks overall for this time of year ever since the data series began. And the summer driving season is just about to begin. And that leaves the markets at a very dangerous place. And that is even without China being fully back, by the way, to work. And from what I can tell, OPEC does not have much gas in the tank to pump more oil on a daily basis. So something that actually our previous guest, Adam Rosenzweig, pointed out weeks ago. But with that said, Rob, let me ask you what has caught your attention in the last few weeks since we last spoke, other than the Queen, of course.
Yeah, the whole oil thing is just a disaster. It always amuses me, though, when I see, and I think I've seen people, I think I've complained about this before, but I see Americans complain that, gas is costing them $5 a gallon. And in the UK now, it's more like the equivalent of $9. So yeah, I mean, at one point last week, petrol prices in the UK were rising by about 1.5% a day. So that's kind of, verging on kind of hyperinflationary sort of levels. So
Indeed.
So yeah, it's there's always a lag before these things start to affect the economy, but it's hard to believe that they won't. But anyway, let's kind of move away from that, and I'll give you some very quick numbers. So year to date, I'm up 36%, and I think it was probably about a month and a half since I last spoke to you, but just to kind of give you some figures then. So the first quarter I was up 27%, and then in April I was up 4.5%. In May, I was down a little bit, like 1.5%, which was a bit of variance because I think CTAs generally were probably flattish in that month, but not me. And so far this month, I've made like 2%. So far it's shaping up to be quarter one, an excellent quarter, obviously 27%. Quarter two at the moment is shade under 7%. So still very good, although not the kind of crazy returns of Q1. In terms of where that performance has come from, which kind of leads us back to the question of, where are the markets moving? So if I look at the, let's see, what should I look at? Let me look at Q2. So Q2 performance so far, top market is the yen. The yen has been, a big market. So obviously going completely hammered. So I'll tell you a little story, actually. I was at a conference last week, and most of the other people on in the room were discretionary traders, and so they all kind of are very good at talking about the markets. I'm not very good at talking about the markets. I'm much better at talking about the systems I use to trade the markets. But the guy, we're doing a Q&A session, and the guy said to me, so the yen's getting crushed today, I assume you're making money out of that. And I said, well, I don't actually know whether I'm short yen or not. I need to check. And everyone in the room was laughing. I'm like, no, genuinely, I don't know what my positions are, because I'm a systematic trader. I get regular positions reports and I glance at them, but I don't necessarily focus on them as closely as I would a discretionary trader. So I check my phone and I'm like, yeah, I'm still short yen, so still making money out of being short yen. So they all thought I was joking, but I was being deadly serious. In fact, one of the nice things about going on this podcast is it does force me to actually look at my positions at least once every 6 weeks or so. So maybe that's a good thing. So yen was the biggest market, but also up there were crude oil, still making money out of energies, even though my position's smaller than it was in Q1 because of the increase of oil. Soy complex I've done well in, also done well in corn. Interesting to see the Bund in there. So I've got a short Bund position, and that's done pretty well over the last couple of months. So it's unusual to be short a bond market in a CTA backtest because of obviously the secular trend in interest rates plus the positive carry normally. So it's kind of interesting to see when you do get short positions in these markets and make some money out of them. That's quite nice. Let's go to the other end of the spectrum. I'm just glancing at markets I've not done so well in. There's not really any key patterns there. Aussie dollar, I don't know, iron, pound, euro, live cattle. I'm not really seeing any interesting patterns there. So let's skip over that. Today's positions then. Where are my positions at the moment? So I'm having to check this because I don't know it off by heart, as discussed. I'm running at about half average risk target at the moment, 12% annualized standard deviation. So a little bit higher than a few weeks ago, but not still massively high. I'm actually running quite a lot of positions in there. So I'm running about, just trying to do the maths in my head, I'm running about 18 positions at the moment. So the reason for the low risk is the fact that those positions are, at least on paper, quite uncorrelated. So, if that suggests that I am potentially running a much higher risk if you assume that all the correlations changed. But anyway, my biggest short position is the Bund. Second biggest is the yen. So that kind of makes sense. I'm also short Korean 10-year bonds, short gold, short Bitcoin. And then the long side, again, the same markets I just mentioned. So long gas, long crude, long soy, oil and beans, long corn. So, and interestingly, I'm currently long the V stocks. So I'm kind of betting on implied volatility in Eastern Europe kind of creeping up a bit, although that's not a massive long. So yeah, I think a few weeks ago when I was last on, I said the portfolio was fairly kind of balanced, if you like, and not taking big concentrated bets everywhere. That I think that's still the case. It's and I'm not sure whether this is an artifact of the way that I'm now constructing my portfolio, or whether it's an artifact of the way the markets at the moment have some nice trends, but they're not focused. It's not like all in energies or all in yen. It's in energies and yen, and there's also a little bit of short bunds in there, and a few other bits and pieces.
Yeah, it's been very interesting in the sense that it has been somewhat broad-based in terms of the trending behavior, not necessarily at the same time. It's kind of rotating from one sector to another, which is, of course, a beautiful pattern for trend followers in the sense. And yeah, no, a great update on that, and congrats on the year so far. I think it obviously has been a spectacular start to the year for trend followers in general. And actually, I think this week, if I'm just looking at the week, I would say it's been a solid week for trend following strategies again. Overwhelmingly, the winners this week is going to be short and long-term fixed income, because the short positioning that I would imagine most trend followers have, just like you, are just paying off at the moment. And of course, also we've seen a bit of a renewed dollar strength, and that's played out pretty well, I think, for most trend followers this week, especially maybe against things like Swiss francs and the yen and the euro. And then energy markets, as rightly you said, although they are still moving nicely in an upwards trend and made money this week without a doubt, the gains were probably a little bit more modest compared with some of these other sectors that I just mentioned. The same for the grains. I would imagine they did perform well overall. And this is kind of interesting because that's also what I pick up, that depending on your time frame, equity is a little bit sort of a coin toss, whether you're long or short at this stage. I would agree with you that longer term systems are probably still a little bit long. That's what I pick up as well. But of course, if you have a shorter time horizon, you might have a short exposure at the moment. And then, meats didn't do so well this week, but overall, pretty strong, solid week for trend followers. My trend barometer also increased quite a lot during the week and finished at 66. So now we're back in what I would classify as a strong trend following environment. Good. Well, we got lots of questions. We're going to jump straight into it. But the first question I have to ask you is always the one you want to hear, and that is, how's your book coming along?
It's going well. So I'm basically doing the really tedious stuff, which is doing the kind of appendices and the glossary and all that kind of stuff. So I've sent off the sort of substantial first draft is finished, and I have a bunch of people who are giving me feedback on that, which is if those guys are listening, I won't name them, but they know who they are. Then thank you very much, guys. I really appreciate it. And then the plan is basically to take that feedback, incorporate it into the book, finish the tedious stuff, and I'll be sending the first draft off to my publishers, hopefully within sort of about 3-4 weeks, hopefully, and then there'll be a long job of editing and proofreading, and I've got some work to do in terms of putting together with all my books. I like to put together spreadsheets, so people can actually see how this stuff can be kind of done themselves. Because even if you're a high flying kind of computer coder, everyone can start with a spreadsheet and see how the formula work there. But I'm also going to write some computer code as well and put that on a website. So that's kind of the process. So but it is at the point of like the last 1% is like, oh my God, it's like pushing the rock over the top of the hill. Like, it's really, I think at the end of a big long project like this, I'm not at the end, but I'm at the end of the first stage of doing the first draft. Inevitably, you start to lose motivation, and it's sunny, and it's like, do I really want to be in here typing? So, but I'm nearly there. And Niels, I have to thank you for your continued badgering of me, which I, as I said, would hopefully motivate me to hit my deadline. And fingers crossed, touch wood, I will hit my deadline. So thank you.
Well, there we are. Good for you. All right. Well, the first question you will not have seen, Rob, because it came in a few weeks ago, and I've been saving it for you to come back, because I think this is kind of quite relevant for with your background. It is from Ben. Hi, Ben. And Ben writes, hi, Niels. As always, I follow your podcast starting from the Top Traders Unplugged to the newer version, and the interviews you're doing in between is just getting better every time. Thanks for the hard work you put into these podcasts. Well, that's very kind of you to say, Ben. My question is regarding money needed when one wants to quit working and do trend following full time. How much money is needed when one needs to cover living cost of, say, 120,000, let's call it dollars a year, for a family and expecting 12.5% CAGR? I guess Rob and all of you can talk a bit about that. I was thinking to expect a drawdown of 50% for the first year, so I would double the capital needed. I think 8 times living costs, i.e. 12.5%, would be possible, but I would double that to 16 times. So when the drawdown arrives in the beginning, one has not to quit. To have a little bit of room, I guess 20 times living cost would be a safe assumption. So if 120,000 living costs are needed, then $2.4 million would be the capital to start with. Is this sufficient? And what are your thoughts on the above? Well, Rob, you've done this kind of thing. So what do you think of 20 times living expenses as the capital to trade, to be able to weather a drawdown and to hopefully be able to live from it if you hit your long-term return target of 12.5% CAGR?
Yeah, so this is one of those questions there's no right answer to. I have to say, I think Ben's done a really good job in kind of, first of all, thinking about it in a very structured way. Second of all, using probably fairly, I would say, not too optimistic or aggressive assumptions on his returns. He's not saying, well, I think I can make 10% a month day trading. He's clearly much more sensible than that, or he wouldn't be listening to us, right?
He is sensible because I know who he is.
Yeah. So I'm actually wondering. I used to have a guy working for me called Ben. I'm wondering if it's the same guy, and he's now at the point of thinking about retiring. I hope it's not him, because
I don't think it is. I think I can be pretty safe saying that it's not him.
Good, because the guy I'm thinking of is far too young to retire. I think it would be a disgrace if he did that. Anyway, I'd say. At the end of the day, it comes down to your personal risk appetite, right? So if you're comfortable with those numbers, Ben, then go for it. One thing I would say is don't forget about taxes. A lot of people forget about the effect of taxes. So that 12.5% needs to be net of taxes. There is another way of doing the maths, though. So I'm going to introduce this as an alternative way, and this is the way I actually think about it, which is a sort of a different way. And that's to do the following and say, well, actually, your trading income is uncertain. Okay, it's highly uncertain, and what you should. So one way of thinking about it is think about it in terms of drawdown and say, well, what kind of drawdown can I cope with? The way I think about it is like this. I think about my trading account as like a little mini hedge fund that just does its own thing, and every now and then sends me a check. And that check is effectively any return I make above the high watermark for that. Which is why, I think of it as like a hedge fund. It's mathematically like a hedge fund that's charging 100% performance fees that go to me. And obviously performance fees only get charged above the high water mark. So there we go. So that I see that the kind of money tracked to that fund is money I can't take out unless it sends me a check. So then what I do is say, well, how long could I survive for without those checks? And, so if I would say it depends how conservative you are. So, assuming, for example, the 50% drawdown in year one is pretty conservative. An equivalent way of saying that might be, well, you know what? It's not implausible if we look at the historical record that you can go back, and there'll be periods of 3, 4, 5 years when this sort of strategy doesn't deliver any returns. So I say, well, I need to be able to survive for 5 years without any of those checks arriving. Okay. And in many ways, I've been very lucky since I've been doing this. Actually, there's only really been like 1, maybe 2 years where there's been no checks, if you like. But there's been a couple of years when the checks have been obviously very low, and a couple of years when the checks have been very high. Because that's the other thing; these checks are very variable in size. So what you need to do is to have enough kind of capital to survive, say, 5 years without checks. So you can say, well, I'm going to have 5 years times $120,000, $600,000, as kind of a buffer, if you like. So that's one way of thinking about it. Another way of thinking about it is to say, well, and this is what I do, as is well known, I have a trading account, but I also have other investment income. And I also have other income from things like selling a few books and teaching and a little bit of consultancy and so on and so forth, is to say, well, okay, given that I have all of this other income, and this is sort of the position for someone who's still working as well, right? Maybe still working as well, is to say, well, how much extra do I need from the trading income? And then I need to be able to kind of smooth the flow such that, obviously in a given year, if I get no checks from the trading account and my passive income makes up, say, 80% of my living expenses, then I just need to have enough of a buffer to manage the other 20% effectively. So that's another way of doing it. But yeah, 20 times that, so that the bottom line is 20 times you're assuming a 5% return a year, if you after tax, consistently as well. If you think that's realistic, then and your risk appetite can cope with that, then that's what it comes down to. That's the really simple way of thinking about it, right? Just converting it to a percentage.
Very interesting framework, and I noticed you didn't even include the checks that government seems to be sending out everywhere at the moment. So
yeah, I don't get those checks, Niels, sadly.
All right, good. Okay, now we're back to the questions that came in via your Twitter tweet, I guess. This question is from Gambit. I don't know if that's your real name, Gambit. I would just say, generally speaking, I normally shy away from questions where I don't have a real name, because I just think that, that's at least we could do, is just to put our real name. But let's assume that Gambit is your real name. I have a question for Rob. Would adding a mean reversion system to a short-term time frame, i.e. daily, be complementary to a trend-following system that trades on a monthly or longer time horizon? And is there any benefit in exploring trend trading in spreads such as WTI versus Brent?
So I'm a bit suspicious of Gambit because this is literally like part 4 and part 5 of my book. Part 4
then you should know who he is.
Well, I know. I'm starting to think, well, maybe I do know this guy, because part 4 of my book is basically about trading fast mean reversion, and part 5 of my book is about trading spreads and butterflies in relative value systems. So
in fact, you paid him to plug your book.
The question is, Niels, am I actually Gambit? I mean, that's. I can tell you I'm not, and hopefully you trust me. But there are probably some listeners listening cynically and like, he just wrote this question, and because
tweeted yourself.
We know that Rob gets one opportunity in every podcast to moan about how hard it is writing his book, and then another opportunity to plug his book. So let's just feed him the line and let him get the book plugging out of the way early, so we can listen to the good stuff. So yeah, the answer is that. So let's talk about the fast mean reversion first of all. So generally speaking, the efficacy of trend following tends to be best within holding periods of between, say, a couple of weeks and a year, roughly speaking. It depends on the asset class. Generally speaking, for most asset classes, once you're up to holding periods of longer than a year, you tend to get more of a mean reversion pattern because you can have value type strategies where you're buying low and selling high. And then similarly for short time frames, you get to the point where trend following just stops working effectively. So you've got a low holding periods of a couple of months, a month, a couple of weeks. It depends on the asset class when you start to see this pattern. Generally speaking, you see a pattern where trend following no longer seems to work that well. Now, the question is then, you say, if something's not working, maybe we should do the opposite. Maybe we should do mean reversion. And indeed, it does seem that for holding periods of a couple of days up to about a week, at least on paper, mean reversion does seem to work pretty well. Now, there's the first challenge with any faster trading system is execution costs. But one of the nice things about mean reversion is that you can actually use limit orders because if you imagine the equilibrium price is in the middle of a channel, effectively, you place a limit order at the top or the bottom end of that channel, and then when the price meets that, you execute. So you're not paying the spread, which is what you would normally do if you were trend following fast, say. If you're trend following slowly, you can use execution algos to try and avoid paying the spread. If you're trend following fast, you kind of have to pay the spread because you want to get in there straight away. So that's kind of the sort of basic idea. Now, the other challenge with mean reversion systems is the risk management is absolutely horrible because trend following systems have this beautiful property where they do their own risk management. So even if you, like me, don't use a stop loss type system, you'll basically close your position when the trend has flipped sign. And also because I'm scaling forecasts according to strength of trend, the behavior I get is, as a trend starts to weaken, I start to reduce my position. And then when it's turned, I close and then I go short effectively. So that's a kind of self-managed risk management without needing a stop loss. Mean reversion systems don't have that because the mean reversion system in its most basic form will say, price is going down. Oh, cheap. I'm going to buy it. Price goes down some more. I'll buy some more. I'll buy some more. I'll buy some more. And at some point you're going to end up losing a hell of a lot of money. And so mean reversion systems are the kind of horror that we dislike on this podcast. They're negative skew. Okay, they make steady profits and they make sharp losses. So what I've done in the book is to use a trend following filter effectively to kind of do the risk management for that system. So what that means in practice is it will only ever do these mean reversion trades in the general direction of the slower trend. So it'll buy when the trend comes off slightly and sell above the trend, but it will never go short if the overall trend is up. And that makes it a little bit more correlated with trend following, which obviously isn't as good. But on the other hand, it improves the kind of risk management properties of the strategy and also improves the Sharpe ratio for what it's worth. Now, there are challenges in combining that with the trend following system in the sense that there's challenges with combining any strategies that trade differently together because you can't do what I normally do, which is just to essentially calculate this risk-adjusted forecast of future returns and then just take a weighted average of those across lots of different systems and then execute the optimal position. You can't do that here. So you've basically got two choices. One is a very complicated option, which is to build some kind of netting into your trading system. So the way this would work would be, you imagine you've got a daily system, generates trades at night. This is what I do actually at the moment. Then in the morning, it has a trade that it wants to do. What you then do is turn on in the morning your fast system. And basically, if an opportunity comes to net that trade against the faster trading, then you net it. And that's one less order you have to execute. The other thing you can do, which is much simpler, is to actually and this makes a lot of sense for me because I can't trade as many markets as I'd like, which is why I have this dynamic optimization, is to basically carve out certain markets where the commission per contract is relatively low because although we're not paying for the spread, we're still paying commission when we trade this mean reversion system, is to carve out a portion of your instruments and say, well, okay, these instruments here, we're going to trade with this faster system. And then, we kind of don't trade those with the slower system. And obviously that's a lot cleaner and simpler. So that's the kind of that's the sort of one of the cool things in the book, if you like. It's the only system in the book that has a Sharpe ratio above 2. And I can tell you that I have the table saying the Sharpe ratio is 2, and I immediately say in the next paragraph, ever since I was a little boy, a little quant researcher, I've been told never to trust a Sharpe ratio over 2. Do not trust this Sharpe ratio. But on the other hand, we would expect it to be higher than a slow trend following system because it's trading quicker, and because of it, it's giving you some negative skews. So you kind of would expect to get paid for that in Sharpe ratio.
Sure. Yeah, makes sense.
Yeah. So
what about the spreads?
What about the spreads? I was going to say. So I won't go into massive detail about these because this is more of a well-known thing. And I think, for example, Moritz has talked about his spread trading as well. So what I do in the book that's kind of something, an approach people may not have seen before, is basically to create what I call synthetic instruments. So if we take a spread like, so there's 2 different kinds of spread. There's cross instrument. So I'm a fixed income guy originally. So I would think of something like the German Bund versus the German Bobble, for example, 5-year, 10-year German as a cross instrument spread. Or alternatively, I could do a calendar spread in something like the Euribor future. So both of those things are bets on the slope of the yield curve, but in different ways. And the idea is you essentially create a synthetic instrument and you create a price for it. And then basically with some relatively simple maths, you can just do everything the same. Okay, so it means you can fit relative value instruments into the same framework as the directional trading. So it just makes your life a lot easier. So that's the kind of main innovation of the book in that respect. But the basic idea of trading spreads as trends is not, it's fairly well known and a lot of people do it. And also, things like a butterfly, for example, those tend to be more mean reverting. So yeah, these are fun things to do. The problem is, there's a couple of problems. One is time and effort. So these things are all a lot more complicated than just punting, buns outright, say. And if you're fully automated like me, there's kind of a lot of operational complexity associated with putting these things in. And the other issue I should very briefly mention with the relative value stuff is obviously increases the amount of leverage you need, particularly for something like, say, a calendar spread in Euribor, where these things are very highly correlated. And again, that it potentially puts you in a dangerous position in terms of, sharp losses if these things become decoupled.
Yeah. All right. Well, the next question comes from one of your other Twitter accounts, Rob, because the question is from Younggotti, so that could also be you. We don't know.
It's not.
I have a question for Rob too. He even says 2. I mean, it's like you forgot that you already sent yourself the question. Yeah. What's your take on the trend following, pun intended, in the CTA industry towards alternative assets, including less liquid futures and OTC contracts? It looks like every major player has launched a program which, at least in some part, has exposure to such assets. In theory, the more assets, the better. But I wonder, how can multi-billion-dollar funds trade something like cheese futures? My suspicion is that such assets actually get a very small risk allocation because of liquidity issues, so that mostly becomes a marketing trick to justify higher fees. I was also curious what residuals stand for in your daily automatic P&L report. It is often a large factor than the actual performance of your dynamic trend following carry strategies. So obviously we're going to talk a little bit about alternative markets later in this conversation. So maybe we keep this answer a little bit shorter because we're going to come back to it again. Yeah,
I mean, if you look at cheese specifically, I just had a quick look. I think the most liquid month traded 43 contracts a day recently. And in the way I think about it, which is annualized dollar risk, it's about $360,000, which is about 1/5 of the minimum limit I would need to trade the thing. And obviously I'm much smaller than a big fund, so they would have much higher limits. It's a tricky one because on paper, the more things you add, the more of a theoretical, you do get a theoretical benefit, but it kind of tails off after a while. There is a cost. There's a cost to adding these things, an operational cost, because even if everything's automated, particularly if you're trading OTC instruments, for example, you need to beef up your back office a lot more than you do with futures, where you can have everything a bit more systematic. I think, I remember actually having a discussion with the COO of AHL when he kind of dragged me into his office, and there's a list of like 50 futures markets or OTC markets I wanted to add to one of our funds. And he's like, come on, 5-year Indian interest rate swaps or something, really. And I'm like, well, yeah, I think there is a kind of marginal benefit to all of these things. The thing is, when you're trading $20 billion, even a 0.001% allocation will add probably more to the bottom line than the additional management cost of doing it. But yeah, there is a point at which something is so illiquid you can't trade it, clearly. I mean, milk is more liquid than cheese. That's a joke. The second question, very briefly, because it will probably only concern a very small number of people in the audience, but basically the residual is due to a mismatch between two different ways I calculate P&L. One is to look at the overall value of the account over a 24-hour snapshot. The second is to look at the prices of things that I hold and see how they've changed. So there are two reasons why there would be a difference. One is a timing mismatch between the two periods when I capture the price. And the other is because there are other things going on in the account apart from just futures changing price. Like, for example, I have positions in different currencies for margin. Those will have P&L. I also have some fees going out of the account and so on and so forth. But that's quite relatively. What tends to happen is over short periods of time, like one day, the mismatch has a big effect, which is what he's seeing, because the only thing I publish on a daily basis is the daily P&L. On a longer period of time, like the reports that I tell you about, it's less about the mismatch and more about the other effects that are coming in. But just to give you a feel for the kind of quantum of this thing, if I look at my performance year to date, which I think the overall number was like 33%, the residual P&L is 1.8%. So,
okay.
It's not over the course of a whole year. It'll be of the order of 3%, and the vast majority of that will be due to FX. Because if you think about it, I'm typically holding 30% margin, right?
Right.
That's all in foreign currency for me because I don't trade any GBP sterling futures. So I'm exposed to the P&L on current of 30% of my account has currency P&L. Well, if you think that the average currency probably moves about 10% versus sterling in a given year, recently it's been of the kind of that order of number, then that's 3% plus or minus.
Yeah. No, that's fair enough. Well, another Twitter account comes in here. You had to really be creative with this one, Rob. It is from FluffyDunny. There we are. And then the question is, do you ladder into and out of positions, i.e. 2 or more entries to minimize false breakout losses? If loose pants are needed after entry, wouldn't a full position entry cause a lot of losses on false breakouts?
This is definitely not me, Niels, because this question has got it's very much not my thing at all. Because as you know, I don't operate a discrete trading system.
Your pants are not so loose, maybe.
I don't even know what that means. I think that's the thing.
You don't know what loose pants?
Yeah, I know. It's a well-known
term used by Jerry. And,
yeah, I know.
And Rich,
exactly.
And it comes from Perry Kaufman. Actually,
yes, I know.
I guess.
I know. I have the book in which that quote appears. Yeah,
the quote is.
Yeah. Why don't you answer this question, Niels? And if I've got anything to add that's interesting, I'll do that.
Right. Well, I mean, I think in general, it all depends on account size, right? At the end of the day. So for large CTAs, professional CTAs, absolutely. We, in order to get to a full position in a market, we would get in with many small steps and we would get out also with smaller steps. So in a sense, if you're only trading a breakout system and using, say, 10 different entries, you're right that it should, in theory, minimize the losses of potential false breakouts. On the other hand, you can say that if you were only using one entry, which I certainly wouldn't recommend, then of course, if the market really does fly after your entry, of course, you're going to make more money from it. So, but in general, because we believe in diversification on all sides in our trading methodology, diversification in terms of entry points is certainly something we would expect to have for most trend followers, I would say. Anything you want to add?
No, it doesn't really. I mean, it's ultimately about getting.
Yeah, because you're a continuous system, so it's different.
When I do introduce in one of my books and also in some blog posts a discrete system which uses a stop loss, I say the most important thing is to match your stop loss to the horizon that you're forecasting at, basically. So if you're kind of trading like 3-month trends, then you don't want a stop loss that's like, I don't know, 0.5% of daily standard deviation or daily ATR, because you're just going to get stopped out within hours, which is ridiculous given that you're looking for trends that last for 3 months. You probably want something that's more like about 7 ATRs or about half the annual standard deviation, which is roughly the equivalent of that. So, yeah.
Yeah, no, that's fair. All right, then we have a question from Mendel. Mendel writes, this may have been asked before, but how would you go about selecting a universe of stocks to apply your existing rules? Most liquid, ? Most diversifying, ? Greedy algo, ? Just stick to sector-specific futures, ?
So this question was actually asked before, but I actually misheard the question and answered a different question. So I'm really glad that it's been asked again. If you go back and listen to the last podcast, I give a very eloquent and long description of how you should select stocks, yeah. but I'm actually talking about a completely different type of trading strategy. This actually is effectively a version of the question of saying, well, how do you choose a universe of instruments, where instruments is normally futures, to trade? Which is for a retail trader is a big issue, because we don't have the cash to trade everything. And I would use the same basic principles, which is basically there are two ways of doing it. There's the way I used to do it, which is the relatively easy way, where you pick a static list of instruments you want to trade. And that's done by a sort of a trade-off between things like costs, the size of position you need to hold it, what I call the minimum capital, and then diversification. And I use basically an iterative process where I add pretty much usually the cheapest instrument that meets these requirements, and then I add the instrument that's relatively cheap and also diversifies, and so on and so forth, and I iterate through that process. Then the second way of doing it, and this is the reference to the greedy algo, because the greedy algo is this thing I use within my dynamic optimization that I use now, where basically I have a huge universe of things I could trade, over 150 futures markets, and then selectively that will optimize for, and today, for example, the 18 instruments which give me the best match to that portfolio, which I can't actually hold because I'd need $50 million plus to do that. So there's no real difference between applying those methodologies to stocks, to futures, with a couple of exceptions. Actually, with only one exception, and that's that the sort of tick size in stocks is much smaller. So you can normally trade stocks that are much smaller in size than a typical futures contract. Even if you're not getting into the murky world of fractional stocks, which you can do at certain retail brokers that we won't name, but are named after mythical English folk heroes who rode around in forests and hung out with people called Maid Marian. But we won't name the brokers, obviously. No, that would be bad. But they do offer fractional shares, but there are disadvantages with trading with people like that in terms of hidden costs. But even for your unless you're trading like Berkshire Hathaway class A, normally a stock costs a couple of $100 and has annualized risk of a couple of $100 times 20%. So it's you can trade much smaller fractions. So you can trade a lot more stocks than you can trade futures with, say, a $100,000 or a $500,000 account. Is what I'm saying. I'll just briefly mention sector specific futures. So one way of getting around this problem is to say, well, you know what? I want to get exposure to the stock market, but I want to get at a more granular level than just trading, say, the S&P 500 or the Eurostoxx 50 future. But I don't want to trade stocks because there are actually operational issues with trading stocks. Futures in many ways are much easier to trade around things like, for example, constructing back-adjusted prices and not having to deal with dividends and stock splits and corporate actions and all this kind of stuff. So you could say, well, I can get pretty good diversification by trading stocks, sectors futures, which are listed in both the US and Europe and are pretty liquid, actually. I don't trade the US ones because I'm not allowed to. There's a regulatory issue there, but I do trade the European ones. And in fact, at this very moment, I can tell you that I do have positions in, for example, I am long the EU oil sector future. So I'm long a bunch of European oil companies. That's like another way of expressing the long oil bet, if you like. And I'm also long the the basic sector. And I can't remember what basic means, but I guess it's
Probably base raw materials.
raw materials or something like that. Yeah, exactly.
Maybe.
So that's another way of expressing the commodity boom thing. So I do trade these things. I even have positions in them at the moment. So yeah, that could be another way of getting more granular into stocks without actually trading stocks. Because yeah, if you have the manpower and the ability to trade individual stocks, brilliant. You get the diversification benefit, but it's moving away from futures and therefore making your life more complicated.
Now, you brought along 3 topics, but you actually asked me to start with another topic beforehand because in the last couple of days, there was a paper out from your old employer, our friends at AHL. Always interesting to read what they do or write about. And they were publishing something about trend following. So that obviously is very relevant for our conversation. And it's also relevant in the sense that it talks about the topic that we had in one of the questions earlier, and that is kind of if there are any advantages in having these alternative markets compared to a more classical portfolio, a topic that we, of course, discuss a lot here on the podcast, as we have a little bit of a different opinion about it. They also talk about trend following, what works best in crisis periods. They talk about trend following and in particular exposure and P&L opportunities in fixed income, which is also a very relevant. And then they talk a little bit about the outlook for trend following, which of course we all want to know. So why don't we dive into it? Do you want to jump in and give me your thoughts on that? You said you might have a surprise in this, so I'm kind of a little bit nervous now. So let me hear what you have, and I'll do my best to keep up.
So yeah, but it's only 5 pages. But as you say, it kind of really packs in a lot of interesting findings. So let's start with the one that relates to the questions. So what they do is they divide markets into traditional and non-traditional. Okay. So this is kind of a little bit different from the take we often take on this podcast, which is dividing trend following into, traditional and non-traditional. So, pure kind of ideologically wonderful trend following a la Jerry, and then you have the heretics like me who, But that kind of characterization is obviously based on how you trade, not based on what you trade. Okay, so this is a bit different, right? This is based on saying, well, traditional trend following in this context is trading, your core futures markets. Non-traditional is trading, a lot of stuff that's, for example, not futures, so over-the-counter markets, OTC markets, also individual stocks, things like forward FX and so on and so forth. And why this is particularly important for AHL is the most successful fund that AHL has had over the last, I believe, 10 years is a fund called AHL Evolution, which was primarily designed for exactly this purpose, for trading things which are not futures, but trading them in the same way as they trade the futures, if you like. And this thing has performed incredibly well year after year after year. And I obviously was closely involved with it when I was at AHL. I think at one point, so like 40% of the assets in that particular fund I was managing. So, I'm very familiar with it. And the one question clients always used to say to us, actually, there was 2 questions. One was, can I get an allocation to this fund? Because we had to keep soft closing it because of capacity issues. Because obviously, a lot of these markets, like the ones we were discussing earlier, not great capacity. The second question they would say is, well, what is it about these markets that makes them trend better than traditional markets? And I would always say, look, I don't think there is a particular reason why there's something special about these markets that makes them, so much better for trend following, or indeed, we weren't just doing trend following, doing carry and other things as well. I believe the outperformance of evolution is basically 2 things. Firstly, just luck, frankly, because, it's just luck. Secondly, it's down to diversification. This fund had more internal diversification within it because it had allocation to all these random things that were very uncorrelated to each other. Whereas a traditional futures CTA portfolio, obviously had very much the things, you basically have like 3 or 4 big bets in there at any one time, right? That's kind of the maximum you could get, in terms of stuff that was going on there. the client, and the clients ever really believe me. Now, what's happened this year, interestingly, is exactly the opposite, and this is the thing that's happened. And I'm guessing this is probably why this article has come out, because someone within AHL has noticed that the narrative they're having to put up with the last 10 years, which is, well, why is evolution so much better than anything else? All clients now are turning around and saying, well, why is evolution doing so badly, relatively speaking? So they've put together this thing and said, well, yeah, this year, the first 5 months at least, traditional has been better than non-traditional. Okay, but obviously because they're quants, they're researchers, they're interested in not just explaining what's going on now. They look back in history and say, well, let's look at some earlier crisis periods. And there's some definition of a crisis that we don't need to go into, but they come up with a selection of crisis periods. And they look at the performance of trend versus alternative in those periods, and they see that the traditional markets do better, generally speaking, in these crisis periods. So that's kind of the broad brush approach. And they do say it could be related to diversification, right? So they say, well, maybe the diversification is something to do with this. Maybe the diversification that makes this thing better in the past makes it worse right now because there's a crisis happening.
Okay, so I mean, super interesting insights.
But I disagree. I disagree with this. But you ask your question and then I'll explain why.
No. It's interesting, your insights, because you work there, you were involved in it. That's what I mean. That's very interesting that you have those kind of insights. My question to you, first and foremost, is: do you think this article reflects evolution? Or does it reflect a traditional trend-following model, pure trend, but where the only difference is the markets? Because when you talked about it, I got the sense that evolution is not just pure trend on a lot of markets. It's doing other things as well, which could explain why it had outperformed. Then we were not comparing apples to apples. So I just wanted to clarify that and then let you go on and talk about where you disagree. And then we have the other part of the article, which is about the fixed income, which is also quite interesting.
So you're right. But then it's also the case. So basically, AHL don't really have a pure trend following fund, right? They have things that are more trend following than others. Evo actually is closer to a pure trend following fund than some of their other funds, to be honest. Now that the article actually, and obviously I've just read the article. I've read the footnotes, but I don't necessarily know exactly how they've done these things. But it looks like it's simulated, which means they've probably taken a fairly basic trend following strategy and applied it to these markets to get these results. So you're right. It's not precisely reflecting the returns of these two funds, but the funds are not sufficiently divorced from the idea, basically the relative performance of these two funds will show that pattern. Evo will have done better than the futures funds for much of the last 10 years, and going back further, actually, to be honest. And then the last few months, Evo will have probably done relatively worse, I would imagine, although I haven't checked the numbers, to be honest. But anyway, all right. Yeah.
You said you disagree.
I disagree.
So
I disagree. Well, the first reason I disagree is although there's an outperformance, it's not huge. It's about, I think it's about 0.2, 0.3% a month, which is 3.6% a year, which isn't very much. And actually, the main thing is, if you look at this graph, and if you're looking at the paper, Niels, or people are following along at home and managed to download it, there's a graph at the end of page 3, and it's got a dark blue, a yellow, and a light blue section. The light blue section shows the monthly performance in a crisis, and basically, world stocks are down by 4% a month. The B Top 50 is up 1.5%. The kind of benchmarks, so the B Top 50 and the SG trends are up about 1.5% a month in those crisis periods. And then the alternative markets is up about 1.9%, and the traditional futures markets are up about 2.2%. So the kind of really the main message of that graph to me is, in a crisis, trend following works. But we already know that, right? And it works whether you look at the market benchmarks or whether you look at this back-tested simulation. That's great. Then within that, you've got this relatively small, to me, outperformance between these two markets. Now, the other thing I've not been able to work out from looking at the article is how many of these crisis periods there are. So is it like, is
is it like 10, 20, 30? How many months of crisis are they looking at? So I think it's unlikely, to me at least, that this difference in performance will be statistically significant, because I just don't think there is enough data points and a big enough difference between the two of them. So to me, it's one of these to me, it's the exact opposite of the argument I was saying earlier. Is there a reason why these EVO markets, these non-traditional markets, are so much better than these futures trade markets? No, it's just luck and diversification. Is there a reason why they're particularly bad in crisis periods, including the first 5 months of this year? I don't think so. I think it's just luck. I really do. I don't personally think that's meaningful. But it's kind of still, in a way, almost nice to see this, because it's quite amuses me, actually. Like when A is doing better than B, I was like, why is A so much better than B? Like, it's just luck. They don't believe you. Now it's like, well, why is B so much better than A? You're like, well, the answer I gave you a second ago. It's just luck. I really don't think there's anything meaningfully significant difference between A and B. It's just luck. It really is. I mean, there are. It's we can go into things like, for example, these OTC markets tend to be more kind of things like, say, emerging market bonds, for example. The things that are more likely to do badly in a crisis. It might be that if you're trading them relatively slowly, you can't quite short them quickly enough. There are perhaps structural reasons why some of these instruments wouldn't do quite as well in crisis periods, but it's pretty small beer. I don't think it's anything to get too excited about. So shall we move on to the next part of the article?
We definitely want to move on to the next point. I want to say just quickly that I will link to this article, this paper, in the show notes. So just go to the show notes on the website under this episode with Rob, and you will find a link. And so that's one thing I wanted to say. The second thing I wanted to say is that, in my own simplistic way of looking at this argument, because it is an argument that we have, or a discussion, I would say, we have on the podcast between the five of us. And the way I look at it is, and maybe evolution is a special case, and I don't even know how far it goes back, et cetera, but also, again, can we completely say it's pure trend? Probably not, and that has a lot of caveats. What I will say, though, is when I look at managers where I know they have been trading these portfolios of hundreds of markets for a long time, for a relatively long time, where we can say, okay, there's enough data here. And if I, for example, compare it to managers that I know well that are trading the classical trend-following portfolio of 50, 60 markets, I actually don't see the broader diversified portfolios or managers doing better. So that's my first very simple screening of that. On top of that, and this is again just for my own account, so to speak, what I worry about is that, and this goes back to my bigger theme and thesis about where trend following is heading, I worry a little bit about that a lot of these alternative markets, especially if you go into OTC stuff, especially if you go into countries like China, frankly, et cetera, I think that they have all been great, but they've all come at a period where liquidity has been ample, stability has been great. And so if my own thesis about where the world might be heading in terms of a more fractured and deglobalized world, with less liquidity, frankly, certainly as long as the central banks are stepping on the brakes, I worry that liquidity will become much more important, and that can add additional risks, let's put it that way, to these quote-unquote alternative markets. So that's just for my own account. There's no right or wrong. I have no idea if I'm right on this point or if my concern is valid, but that's how I see it.
Yeah, I mean, yeah. I'm just going to really quickly address those points, Noz, if you don't mind. So the diversification, I do believe that it's worth having these things in your portfolio if you can, because of the diversification element. For the same reason that Jerry's a big fan of trading single stocks. Which you can say, well, they're not the same thing, but it's the same argument to say, well, actually, if you can go if you're only trading, say, 7 futures, you can do better by trading 14 futures. Okay. If you're only trading 50 futures, you can do a bit better by trading 100 futures. If you're already trading 100, well, okay. If you're already trading 150 futures, which is probably getting to the limit of where you can in terms of liquidity, pretty close to my limit, and got a small account, then, well, where can you go? Well, you can go into single stocks. You can go into OTC, and there are OTC markets, for example, where you just can't get exposure in the same way with futures. An example would be, FX forwards, where you can trade a lot more currencies than you can trade with the IMM FX futures, for example. Indeed, some of these IMM FX futures are not very liquid at all, whereas the FX forward markets are massively liquid. Now, I guess there's a danger in having too much of your portfolio in these things. Clearly, I mean, if you were to kind of have a liquidity-weighted basket of all the tradable assets in the world, then futures would be not a massive percentage, to be honest, because you've got bonds and stocks, which are much, much bigger markets, and then these OTC markets probably are in total the same size as the whole futures market if you add in literally everything. I mean, the FX market is obviously massive, but so there is a kind of probably reasonable weight to have in your portfolio to these things. So, if you take AHL, for example, I believe it's still true. You can't just buy Evo by itself, right? They won't let you. You have to buy it as part of a package with the futures markets, because, that way you're getting the maximum diversification, right? Something like 70% futures, 30% OTC is probably about right, actually, in terms of diversification benefit. Now, of course, if liquidity changes and that 30% is no longer liquid enough, well, then you have to shrink it, and that's what you can do. If all this stuff's inside a single master fund, you can actually deallocate from the other stuff and put it back into futures markets. And yes, it will reduce your diversification, but at the end of the day, there's no point in trading cheese. There's no point trading an OTC market if the liquidity in it has disappeared. And we actually saw this back in 2008 when, AHL had to radically shrink the size of their CDS portfolio for reasons that I do not need to explain. And then, over the following years, one of my jobs was to kind of bring CDS it's back in size to an extent. But there were things we were trading in 2008, like, for example, sovereign CDS, that we didn't, certainly not while I was there, we never traded again because the liquidity just disappeared and never came back. So yeah, I think you're right, but I still don't think that's an argument for, if you can, never having any allocation to this stuff.
No, and fair enough. I just wish I could see it more clearly in the data, and as long as I can't, it's hard for me to say wholeheartedly that I think 200 markets is better than 60 liquid markets.
Theoretically, it is, right, and it's
theoretically, it's all great.
And the thing is that the theoretical stuff actually understates the importance of diversification, and this is Rich's big point, right? That because of the fact you're looking for tail events. Because the theoretical improvement in correlation terms from, say, 50 to 100 is nothing, right? It's like a 5% improvement. But if you look at your actual improvement in a back test, I know back tests aren't everything, but if you look at the actual improvement, you see a much bigger improvement than that, and that's because correlation is a linear measure, and it doesn't account for the fact that when you have 100 rather than 50 markets, you're twice as likely to pick up these tail events than you were with 50 markets. But anyway, shall we move on, because this is a debate that we can have forever. So the second part of the portfolio was about fixed income, and I actually alluded to this earlier because I said, well, in the back test, it's unusual that you're ever short fixed income because of the secular downward trend in interest rates and the carry. But generally speaking, if again they've looked at crisis periods, and they've done this in a kind of anecdotal way. So they've said, well, here's a bunch of crises: LTCM, Tech Bubble '99, 2008, and so on and so forth. And they said, well, what does a trend following system do in those periods? Is it long or short bonds? And does it make money out of being long or short bonds? So the interesting thing about that is that the current crisis period is very unusual in the sense that, generally speaking, we are short bonds as trend followers. But obviously we're still making money out of that because bonds have been going down in price. So it's been quite an interesting one because, again, going back to my days at AHL, the question we have from every client is, well, you guys are going to lose money when interest rates start rising. Every single time. Because, your back test has benefited from these massive secular trends in bonds. When that's not there, you're going to lose money. And the honest answer is that if interest rates are flat or only falling slightly, or or move sharply, then yes, you will lose money as a trend follower.
But the environment of the last few months, where we've had a fairly steady downward trend in bond prices, a fairly upward trend in yields, which has more than offset the positive carry effects. It's been great for bonds, and shorting bonds, as you say, has been one of the trades that's kind of taken over from the energy trade at the top of a lot of P&L lists, along with being short yen. So again, it's kind of an interesting. I mean, again, I put my statistician's hat on, and I say, well, this is even more of even less of a significant result than the previous one. But on the other hand, I can say I have myself done work on looking at this exact issue in a more rigorous way, looking at lots and lots of data. And generally speaking, the bottom line is that you will not make as much money in a rising interest rate environment as you will in a falling interest rate environment, but you should still make money as a trend follower. And obviously that's a lot better than being, stuck with just a 60-40 portfolio, which has not been great for the last few months.
Yeah, no, absolutely.
So should we very quickly talk about the inflation part and then stop?
Yeah, I was going to say, let's round it off with some inflation and the outlook.
Yeah. So the other thing they've done, because obviously this is very topical when we're talking about petrol prices at the top of the show, or gas prices, as our American cousins like to say. And they've looked at real returns for different assets, including trend. And the nice thing about this, actually, this is probably the most substantive piece of research in the paper, because they've gone back nearly 100 years in terms of their data, which is fantastic. And what they're doing actually is also interesting, because there's been a fair few people saying, well, how does trend following do in high inflation and low inflation? And a lot of those pieces haven't been great because they've gone back to just 1970. So there's only been really one period of high inflation. This is lovely because they've gone back a lot further. And the other thing they've done is they've looked at basically what happens around inflationary periods. So during inflationary periods, the last 6 months of inflationary periods, the last 6 months following the inflationary period, and the last year following the inflationary period. The bottom line is that trend does well in all of those periods. And then other asset classes do about as well as you'd expect. So, for example, during inflationary periods, commodities, gold do well, equity does badly, treasuries do badly, high yield does badly. That pattern doesn't really change much towards the end of the inflationary period. And then following inflationary periods, you start to see rebounds in equities, for example. You start to see rebounds in treasuries. But things like commodities, not so much. And that's quite noisy, I would say, the after inflationary story. There's not really much of a story there, but there's a very clear story about inflation, which, again, assuming we are entering a period of protracted inflation, and I think it's going to take at least a year for the current structural bout of inflation to work its way through the system, if not longer, then it's good news for trend followers, at least if the historical record back to 1926 is anything to go by.
Yeah, no, absolutely. And then they round off with their own conclusion, so to speak. And I'm not going to read the whole.
I don't think we should read the conclusion, because I think we should let people go and read the paper and give.
That's fair. Yeah,
because I feel bad for Graham that we've basically just completely stolen his thunder by going through the whole paper in such detail.
I think it's great for him, actually, because he gets an audience that he might not have in the first place. Yeah. So I think it's,
he can. If people can download it,
positive thing.
Read the conclusion for themselves, and
okay,
it's a great
let's
paper.
Leave it with that. There is one other article that I just want to, for personal reasons, highlight, because I think it is, again, one of those things where I don't necessarily fully agree with the way it's portrayed. And it's an article that came out, I think, on Bloomberg. And it's talking about market-crushing quants face tougher times ahead, a reference to CTAs. And there's obviously in the beginning of the article, there is some talk about how well CTAs have been doing. And then they start talking about all the things that kind of can go wrong. And Charlie McElliott at Nomura, whom I'm not always agreeing with, comes out and it says, yet now, they're all at risk of facing choppy market. We're talking about CTAs now. Yet now they're all at risk of facing choppy markets, with the S&P 500 vacillating within a rough 100-point range for the past 2 weeks. Charlie McElliott, across asset strategies at Nomura Holdings, said Wednesday that a recent bout of short covering in equities by CTAs had left them delicately balanced, even as their cumulative global exposure to stock futures was back to being net long. Their buy and sell signals sit in a tight band close to current levels for a number of key futures, McElliott wrote in a note, meaning small moves either way could whipsaw CTA strategies. And what I take exception with here is that although he might be right, that for the small portion of the portfolios that are within the equity exposure, we could have signals that might change relatively quickly because there is no clear trend necessarily right now in some of the equity indices, not all of them. So he might be right. But they make it sound like that's the only thing we do and that's the only thing that's going to determine CTA performance. And that's what I want to just put a big nail through and say, no, in fact, our performance attribution from equities this year is probably pretty small because that's not where the action is. And by the way, as we've explained now for the last more than an hour, CTAs are very diversified. And so what goes on in one particular sector really is not going to determine our performance one way or the other as such. So that's what I take exception with, not necessarily that we have a little bit of a tight range in equities and that our signals might change quickly. That may well be the case. All right. With that said, maybe just a quick rundown of performance. As mentioned, it's been a good start to June. And as you heard from Rob, it's been a great start for him as well. And yesterday, Friday, these numbers are as of Thursday. Of course, Friday was a good day, despite all the negative news and the negative moves in equities and fixed income. But the Beta 50 index as of Thursday was up 2.72% for the month of June, up 18.25% now for the year. SocGen CTA index up 3.25% for the month, up 23.14% for the year. And the trend index is just flying up 3.96 for June, even without Friday, up 30.72 so far this year. Very strong performance. As I mentioned earlier, my trend barometer is back in the mid-60s, so it's very strong. MSCI World Index down 5.35% so far in June, down 18.26% so far in this year. And the World Government Bond Index, no protection at all in bonds this year, down 1.97% in June, down more than 10% now year to date. And just as a reminder, actually, I would encourage you to go and check out the upcoming midweek episode as well on Wednesday, where we are joined by one of the most interesting thinkers on the topic of investor behavior, socioeconomics, and confidence, a gentleman called Peter Atwater. So you definitely don't want to miss that one. Next week, I'm joined by Mark for another fun and insightful conversation, no doubt. So make sure you send in your questions. As always, you can email them to info@toptradersunplugged.com. We'll do our best to answer them as soon as we can. And also follow Rob and everyone else relating to the podcast on Twitter. From Rob and me, thanks ever so much for listening. We look forward to being back with you next week. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.